Unless you live under a rock, you probably heard a little something about what's going on in the housing market today. Home prices are going up, interest rates are going down. Will the market crash? Should I buy now? Should I buy later? Yada, 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 yada. And now, because of all this commotion and everything that's going on in the market, a lot of people who weren't able to afford a home in the past are now considering into buying a home. With all that's going on, there's a new demographic of people that are looking to buy a home now and asking themselves questions like, well, can I actually afford to buy a home? What if I told you in most cases it doesn't really cost that much to actually qualify for a home? What if I told you in most cases that you'll actually save more money on your mortgage than when you're paying rent? By the end of this video, you'll have a better understanding of how much home you can qualify for, and then also the calculations the lenders use to actually see if you can qualify for a home or not. And I'll also throw some tips in as well. What's up, future home buyers? My name's Chris, aka CI, the mortgage guy. I'm a loan originator in the state of Florida, and I make videos to simplify the home buying process. So if you ever considering buying a home now in the near future, make sure you hit that subscribe button so you can understand what the process of buying a home is. In my previous video, I went over what closing costs were, and I broke down the details of the closing costs itself, and also I gave tips about how you can save money in your closing costs. So if you haven't watched that video, I'll leave a card above here. You can click that once you're done with this video. That led to me creating this video here because I didn't want to put fear into anybody's heart about seeing those broken down closing costs and shying away from purchasing a home. So now I decided to make a video basically going over the question I always get: can I afford to buy a home? Or better yet, how much do I have to make a year to buy a home? So in this video today, I'm going to explain exactly what you need to consider when determining whether or not you can qualify for a home. And I'm going to give you a few tips along the way so you have a strategy in place when you buy a home. So make sure you watch all the way through. And as always, I'm going to bring the iPad on the screen so we can go over details together. So first and foremost, what is debt to income? Okay. Debt to income is going to be the calculation that lenders use when actually getting you into a home. Okay, this is going to be what we use to determine if you can qualify for a home. Okay, so there's two types of debt to income ratios. Okay, front end is what you can calculate right now. Front end debt to income ratio is basically the total monthly debt that you have now. Let's say your car payment, your credit card bills, your student loans, any health bills, all of those added up and divided by your gross monthly income. Okay, so that's going to be your front end debt to income ratio. Okay, this one is just for your sake. Lenders don't actually use this one to qualify you for a home. It's just an idea of where you're at now. Can you even afford the expenses that you pay now? The calculation we use is called back end debt to income ratio. Now, back end debt to income ratio is your front end debt to income ratio, so all your current expenses plus that future mortgage payment that you'll possibly have. So let's say your total monthly debt to income ratio is, let's say, $500 of debt monthly. And most likely it's a lot higher than that. But let's say you also are trying to qualify for a mortgage payment. That's another $500. Okay, so you'll divide that by whatever your income is monthly. So things to consider. This goes based off of your gross income. This is for your protection, okay? I'm a lender myself, and lenders are going to qualify you based off your gross income. And gross income, as we all know, is not what you take home. If you sign for a salary of, let's say, $50,000 a year, you don't take home $50,000 a year. You're going to subtract taxes, you're going to subtract insurance, and whatever other monthly payments that you have that is taken out. So keep that in mind, because you may have a debt to income ratio that's borderline 46%, but I went over in one of my other videos in the past where I talked about 5 mistakes people make when buying a home. It's actually maxing out that pre-qual letter, and you can watch that video as well because there's a lot of good information about that. So this goes based off of your gross income. Gross income is not what you take home. This is a problem because you may be at that 46% debt to income ratio, but when we talk about your net income, which is what you take home, your debt to income ratio might be around 52 to 53%. And you may qualify for a home with that, but you'll get yourself in a situation where you'll be house poor. And we don't want to be house poor because that's where there's a big risk of you may go into foreclosure in the future, or you may take a lot of money away from other expenses there. So you don't want to put yourself in a situation where you're spending all this money on your home. Also, unreported bills, okay? Unreported bills could be such as your utility bills. They don't get calculated into this as well. If you have some other payments such as grocery bills, those are monthly expenses that you have to have all the time unless you don't eat anything. And just other bills that don't show up on your credit report, okay? That actually brings up your debt to income ratio. And to help you guys, I left a link down below that has a debt to income ratio calculator, and I want you to add in all of your expenses, including your utilities, and then what else you have on your credit, so you can have a better idea what your debt to income ratio is. Most lenders are going to actually ask for less than 56%. This isn't all lenders. You may see some lenders out there that don't have a debt to income ratio for FHA loans. But like I said, if you're on this channel and you're watching my videos, I wouldn't recommend you go above 56% because chances are you're having an issue right now with paying your current monthly bills. And if you're having that type of problem, maybe getting into a home and adding in another debt isn't the best idea for you. And then for conventional loans, again, most lenders are going to require no more than 46%. So this is also going to be subjective. There's certain lenders that, can go higher, and there's certain lenders that require lower. Each lender has their own set of guidelines, okay? But yeah, so 46% is going to be the general number when it comes to your maximum debt to income ratio. So when you're working with your lender, they're going to tell you what your debt to income ratio is at. They're going to usually, when they send you a pre-qualification letter, that's going to actually max out that debt to income ratio, so you can have more money when you're looking into buying a home. Basically, like say for instance, you qualify for $300,000, that means that your debt to income ratio will be hitting that 46%, or if you're using an FHA loan with most lenders, that 56%. I wouldn't recommend taking out that maximum amount because, like I said, you're going to be in a situation where you're house poor. 25 to 30% is a good number when you go to when debt to income ratio, just depending on your situation. If you have kids, I'd lean towards going lower than that 30% area. If you have a spouse or any dependents, if you're a single person and you don't really have anybody dependent on you, maybe you can go a little higher with your debt to income ratio because there's less of a risk of certain things going on outside. Now that we got over debt to income ratio, what we also have to consider is upfront costs. You finally got into the home and you're about to go into the home. So what goes into actually getting into the home? The first thing is going to be your down payment, okay? The minimum down payment for most conventional loans are 3%. For FHA loans, it's going to be 3.5% or 3.5%. Now, this depends on what you're going to qualify for, but let's say it's $100,000. So that's $3,000 for conventional and $3,500 for FHA. So that's the upfront cost. This is minimum. If you have a VA loan, you can finance 100%. If you have a USDA loan, you can finance 100%. So those are different areas there. And then also lender fees. So lender fees are those closing costs I was talking about in that last video that I posted. Those usually also go on top of upfront costs. That could be the title services, that could be appraisals. Those are certain things that you'll have to pay on top of your down payment. There are certain cases where if you accept the higher interest rate, the lender will pay for your closing costs, and I'll make another video about that another day, where if you accept the higher interest rate and you go and have your closing costs paid off, there's a strategy that you can use to see whether this will be a good idea or not. So make sure you subscribe so you don't miss that. But that's something else that goes into it. And then now we have maintenance. Now, depending on the type of home that you buy, it's a condo or a single family home, chances are you may have to do some repairs when you get into the home, unless buying a home at that premium price and those things are done. At some point, you have to do maintenance on a home, whether that be changing the locks, whether that be replacing windows, certain things that need to be done around the home to make it your home, make it personalized towards your liking. So that's also considered as well. And I also put furniture. That's obviously a no-brainer. When you get into the home, you're gonna need to put furniture, appliances, and certain things inside of the home, because otherwise you're not gonna have anywhere to lay your head. What goes into the total mortgage payment? Every time you pay principal, you bring down your loan balance. The more money you put towards principal, the less you owe towards the bank. Interest is gonna be your fee for borrowing money, taxes, and insurance. And I put additional as well. Depending on where you're at, you could have a homeowners association bill that isn't always calculated into your mortgage payment. And also flood insurance as well. That's another very common thing that gets added on to the loan, just depending on where you buy a home. So the question that you're asking is, can you afford to buy a home? That question comes with the follow-up question is, how much of a home can you afford? What's your debt to income ratio like? And what's your current situation? Any lender can get on the phone and tell you and try to sell you some type of mortgage and do whatever they can to get you into a home. But are you doing what's best for your family and your financial interests, okay? It may be all good to get into a home. It sounds really good because your friends are all doing it. But at the end of the day, you're the person that you wake up to every night. And if you have to wake up in risk of not knowing whether you can afford a certain expense, then getting a home might not be the best decision for you right now. Okay, there's many clients that I've had in the past that were borderline gonna get into a situation where they could qualify for a home, but it wouldn't be the best financial decision because of their jobs wasn't stable. They couldn't maintain certain things with their debts. So I think the best thing you can do when getting to a home is to strategize it, okay? I used to play football in the past, and I was able to make it Division I, and I wasn't the fastest, I wasn't the strongest, I wasn't the biggest, but I had a great plan, I had a great strategy. You can do the same thing for yourself, okay? As far as your finance, you don't have to have a lot of money, okay? But what you do have to have is a plan, a strategy, okay? My coaches would never put me in a game that we weren't prepared for, okay? So it's the same thing. Prepare for getting into a home, and then once you're prepared, when it actually happens and you actually get into a home, you're already ready for it, okay? You're ready to knock it out. That's my first football analogy. I'll probably add some more. I love football. That'll do for today. If you found any value in this video, make sure you hit that like button and subscribe. I'll see you guys next time.